Hey, picture this. You've finally scraped together $10,000, maybe from a side hustle, a tax refund, or just grinding through that gig economy grind. And you're staring at your phone, bombarded with odds screaming about the next big AI stock that's gonna make you rich overnight. Sound familiar? Here's the thing. What if chasing that hype is the exact reason most folks end up watching their money vanish like a bad bet in Vegas? Stick around because today we're talking about how to invest that 10K in 2026 without falling for the flash, using stupid simple diversification that actually builds wealth over time. My name's Perku, and I spend way too much time thinking about why even in a post-inflation economy like this, where housing costs are through the roof and interest rates are still biting, people keep chasing shiny objects instead of steady growth. This video is for you if you're a young professional buried in student loans, a middle-class family juggling gig work and bills, or just an everyday American feeling squeezed by 2026's realities. If that hits home, hit that subscribe button and give this a like. It helps more folks like you find real talk on money. All right, let's dive in. Look, most people think investing means picking the hot trend, like dumping everything into AI because everyone's talking about it. But here's what most people don't realize. That's not investing, that's gambling. In 2025, sure, some AI stocks exploded. Nvidia and others doubled or more. But the hype cycle left a lot of folks burned when valuations got ridiculous and only a couple of the big names actually beat the market. The S&P 500 returned about 16.4% last year, but chasing AI often meant missing that, or worse, losing big if you timed it wrong. We're gonna flip that script with diversification, spreading your bets so you're not wiped out by one bad move. But wait, it gets worse before it gets better. Let's hit you with some shocking stats to show why this matters. According to the US Bureau of Economic Analysis, the personal savings rate dipped to around 4.0% in September 2025, meaning Americans are saving less than ever while household debt hit a staggering $18.59 trillion in Q3 2025, per the New York Fed. That's mortgages at $13 trillion, credit cards over $1.2 trillion, and student loans at $1.65 trillion. And get this, behavioral economic studies from folks like Daniel Kahneman show that 70 to 80% of people suffer from loss aversion, where we hate losing money twice as much as we love gaining it, leading us to chase quick wins like AI hype instead of steady plans. Meanwhile, the historical average annual return for the S&P 500 since 1926 is about 10 to 11% with dividends reinvested. But undiversified bets on trends, they crash hard. Think dot-com bubble or crypto winters. This is where it gets really interesting. Let's break down the math, like I'm sketching this on a whiteboard. Say you plop that 10K into a single AI stock. If it booms 50% in a year, great, you're at 15K. But if it tanks 30%, like some did in late 2025 amid overvaluation fears, you're down to 7K, and psychologically that loss feels brutal. Now compare that to stupid simple diversification. Split your 10K across a broad index fund tracking the S&P 500, 70%, some bonds or a bond ETF, 20%, and maybe a bit in international stocks, 10%. Historically, a diversified portfolio like this reduces volatility by 20 to 30% per diversification studies from Investopedia and Fidelity. Let's calculate compound interest, the real magic. Formula time. Future value equals principal times 1 plus rate times time. For that diversified setup, assume a conservative 7% average annual return after inflation, lower than S&P's 10% to account for 2026's high rates. In 10 years, 10K times 1.07 to the 10th power equals about $19,672. Bump it to 20 years, over $38,700. But here's the brutal math. If you chase hype and lose 20% in year one, you need 25% gain just to break even. That's anchoring bias at work, where we fixate on highs and ignore recovery costs. Now you might be thinking, Praku, but what if AI keeps exploding? I don't want to miss out. Fair point. I get the FOMO. But studies from Richard Thaler on present bias show we overvalue quick gains now, ignoring long-term risks. Diversification doesn't mean zero AI, it means a slice via index funds, not all-in bets. Think of it like this analogy. Investing without diversification is like planting all your seeds in one pot. If a storm hits, everything's gone. But spread them across the garden, some thrive, others survive, and you harvest steadily. That's wealth building in 2026's economy where gig work means irregular income and inflation eats savings. All right, building on that, here's a deeper revelation. People mentally account for money weirdly. We treat windfall cash like 10K differently than salary, splurging on hype instead of strategy. Kahneman's work ties this to social comparison. We see friends posting AI gains on social media and anchor our expectations there. But the uncomfortable truth? Diversified portfolios outperformed single sector bets in 80% of 10-year periods, per BlackRock data. Even more surprising, in high inflation times like now, bonds in your mix act as a buffer. When stocks dip, bonds often rise, smoothing returns by 15 to 20%. I remember when I was 25, buried in debt from gig driving, and I dumped my first 5K into tech hype, lost half in a market dip, felt like a punch. That frustration taught me, start simple. So, actionable steps. First, pull up your bank app right now and open a high-yield savings account. Rates are still around 4 to 5% in 2026. Park 2K there as an emergency fund. Next, open a Roth IRA via Vanguard or Fidelity. Tax-free growth, perfect for under 59.5 folks. Invest 5K in a low-cost S&P 500 ETF like VOO, expense ratio 0.03%. Then 2K in a bond fund like BND for stability, and 1K in an international ETF like VXUS to hedge US risks. Rebalance yearly. Sell winners, buy laggards. Tools like Mint or YNAB track it free. Now, you might be thinking, but Praku, I'm no expert. What if I screw up? Totally get it. That's mental accounting tripping you up, separating investing money as scary. Start small. Use apps like Acorns or Robinhood for auto-invest. They diversify for you. And here's another story. A buddy of mine, mid-30s family guy, chased crypto in 2022, lost big. Switched to this simple mix in 2023, up 25% by 2025 despite volatility. The mindset shift? Stop seeing money as a leaky bucket. Plug the holes with diversification. This escalates to the real eye-opener. In 2026, with housing unaffordable and rates high, undiversified investing isn't just risky, it's a trap, keeping middle-class folks stuck. But flip it. Compounding in a balanced portfolio turns 10K into 100K plus over 30 years at 7%. That's freedom, peace from bill stress, control over your time. Look, the math is brutal, but it's on your side if you play smart. You've got this. Start today, build that momentum. What's your biggest money myth or leak? Drop it in the comments. Let's chat. If this helped, like, subscribe, turn on notifications. This is for education and entertainment only. I'm not a financial advisor. Always do your own research or talk to a professional.